the slogan goes, welcome to Startup Saga. No, it doesn't look good, right? Do I look good with this?
Looks good. I like it.
How about something else? Let me pick up something else. How about this one? Do I look good with this?
I like it.
How you have been?
I've been doing good. How are you doing?
I am fine. How was your new year?
Yeah, we had a great time. Yeah, no complaints at all. We had fun. We did a little staycation here. I
Awesome.
went to the basketball game the next day, so it was good.
Awesome. I missed you last time. Startup investment is what? A science or an art?
So startup investing is not a science; it's a little bit more of an art, and that's why it's always case by case. You have to look at it like a piece of art.
As the slogan goes, people and their dreams. Welcome to Startup Saga. This is your host Sanjay Agarwal. Today's topic is very interesting, investment in startups. When we think about the word investment, what comes to our mind is equity, number one, return, debt, bond, sometime crypto, private equity. But there is one kind of investment we're all very excited about and we don't know much about it. It's investment in startups. Why so? Why there's so much of excitement of investment in startups? Because there is no structured platform where people can go and really evaluate and invest. Number one. Number two, there is a charm to it. You get a chance to become an entrepreneur. And number three, there is an element of like, okay, you can make 1,000 time multiple. Of course, there's a huge risk attached to it. And we'll go through this whole investment, as ecosystem or the psychology behind this whole investment in startups. I have with me Alex Gramatzki. Alex is my Wharton buddy. I've known him for past 4 to 5 years. Alex grew up in Canada. He's a BBA from Calgary. And one fun fact about Alex is that when kids were learning how to drive, Alex was selling soda can in the locker room through the cost arbitrage when that soda can was available in the vending machine outside the locker room. So I think that psychology investment bug was with him since childhood. And no wonder today he has invested in 20 such startups. So let me welcome Alex. Alex, welcome to the show, Startup Saga.
Thank you for having me on today. It's great to see you again.
Thank you. So Alex, today's topic is investment in startup. So, and I know that you're invested in so many startups and we want to really get some fine insights from you. Okay. Why not you begin about yourself a bit? Where did you grow up? How was it? And where this whole investment in startup came to your mind?
Yeah, so I was born in Calgary, but I grew up in Germany, lived there for the first 10 years roughly of my life, then moved back to Canada, played sports, but I was interested in startups and investing in general. My dad was entrepreneurial. He was on the real estate side. He was always telling me about other things he invested into relating from like mad cow disease to like fishing bobbers that wouldn't break to all sorts of other unique ideas that he would talk about.
Yeah. So your dad was a kind of a huge influence on shaping your thought process into finance and investment. Is that a good way to look at it?
I think our parents always shape us to some degree, and we can take some of the good and maybe avoid some of the bad, become the better version of them in the future. But I would say, yeah, his background definitely exposed me to investing.
I read your background in LinkedIn. You are an investor from get-go, just after the college. I mean, did you work anywhere after the college, or you started investing in startup from the get-go?
I started in real estate, but to some degree, that's also investing. But I try to always get some sort of participation, whether it's a management fee or it's an advisory fee. So it was very entrepreneurial. I didn't just want to work from a salary perspective. I got my real estate license right away as well. So to some degree, you become a startup. And I was always looking for more opportunities. My first investment was in the legal tech side of things. And I had dealt with many minute books from many different companies. So when there was somebody trying to solve that problem that I was dealing with, it seemed like a no-brainer to me because I knew I needed the solution. I knew I would pay for the solution. And I knew many other lawyers and entrepreneurs that would also pay for the solution. So it became kind of something that I was interested in, and that was my first investment.
It's a law firm, you said? It's a law firm?
It was not a law firm. It was a company that was solving issues for law firms, but also
Got
for
it.
companies and clients. So it was a legal tech company.
It's a legal tech company, and you knew the founder, you knew what they're doing.
I had worked with the founder before in a previous company. So when he went off and did his own thing and came back and connected with me, I knew he had integrity. I knew he was a diligent person. I knew he had a financial acumen. So there was a few trust factors as well.
So the first investment, let me make sure I understand. It's a startup again. It's a legal tech startup, but your faith came into that firm because you knew them personally. Number one. Number two, you knew what they're doing. You were very comfortable with the solution they were providing. So if you know the founder well, and if you know the industry and the solution they're providing, and you do some research around it, I think there is a level of comfort level in putting money there. Is that a fair way to look at it?
Yeah, when you're investing in a startup, you're investing into the founder because the company doesn't really exist, even though it does. But without the founder, the company's dead. So you really want to invest into the founder and know the founder and understand some of their track record.
Awesome. That's great. So legal tech, but then you went on and made some other investments too, roughly 20, what I know. So what are the different sectors you have invested so far?
I've invested in health, but not pharmaceuticals. Pharmaceuticals are too complicated because there's too many layers of approval. So that can be wellness platforms. I've invested into platforms that are like social media based platforms. And I've invested into a lot of other sectors I even invested into like a podcasting company. I invested into a company that did things for skin health, a company that does like valuations on artwork. And companies that do food related things. So those are the types of things that I've invested into.
Criteria they need to look at before investing in somebody. They may not know the founder also, right? So can you advise us?
Yeah, so I look at the network that the founder has. So another company I invested into, I was introduced to by a friend of mine, and he introduced me to a founder that had already had a previous exit, had taken a company public, and he was essentially starting a social media platform. And I knew that their company was going to change over the years, and they've turned towards the metaverse and pivoted that way. But he was an older gentleman, but he had like 19 grandkids that were all like engineers and tech people and lawyers. So I was like, you know what? You're going to get a lot of free labor, and startups have high burn costs. So I was like, I'm going to invest in this company because you'll be able to reduce your burn by being able to leverage on your grandkids. So
Wow.
they've done incredibly well. They've been able to keep their burn rate down. And I invested in like a 3 million valuation. And I think they're going to go public this year here and north of $1 billion valuations.
Okay, let me kind of get back to this. So you knew the founder again, right? And then you understand even the family tree of that founder looks like, right? And apart from knowing the founder, apart from knowing the family tree, social media attracted you. You felt that like this has the potential, especially the metaverse idea, right? And what else did you look at? Did you look at their business plan, cash flow, stability? Like what other factors did you look at?
I look at the thesis and the traction. So one of the things that's important is traction. Is do you have clients? Do you have recurring revenue? And how hard is it for you to scale this business? Like, are people coming to you? Are they looking for the solution? Or do you have to sell people on the solution? So the most important thing is I look at is traction. I don't dive too much into the technical side of things. If it's too technical and if it's like a hardware related thing or pharma related, it's a pass for me. If I think technically it can be built and you have traction, then it's something I'm highly interested in investing. Then it really comes down to valuation.
Can you go a little bit more deeper on traction? Because I understand other parts. What exactly you mean by traction?
So traction means that you already have people that are either on an email list that have signed up to use your product, or you're already generating revenue. And so that doesn't mean one customer, but it could mean, 10 customers if they're bigger customers, or it could be 100 or 1,000 customers on that side of things. So that's very important. And I look at how is that traction growing month over month? Are you getting more demand? And I think that's one of the most important things to focus on.
But how do you get these data? Suppose myself, I want to invest in startup. Even if I know the founder, like how do I get these operational data? Because getting hold of financial data itself is very difficult. So how did you get hold of these operating data?
So the founders or the CEO of the company should share that information with you as to what their traction is. One of the most important things they should be telling you, here's our consumers or customers. And, we're adding 1 or 5 or 100 customers every month, and we're growing. So last month it was 10, this month it's 50, next month it's going to be 100. So you have a history of growth. And I think that's one of the most important things.
Now, can you take one more example, Alex, and share that you looked at something different than traction?
Something different than traction is valuation. So Canadian companies, for example, were lower valuations than US companies. So there's companies that I've invested in that were Canadian based that I thought the valuation was very reasonable. So sometimes I don't invest in a startup because I think it's going to be a multi-billion dollar company. But I think, hey, that this valuation's at 7 million. I know companies in similar spaces that have been able to grow to 50 million or 100 million. And I think you definitely have the chance to get there. So that's a startup still, but I'm not expecting 100x return or 50x return. I'm doing it based on a valuation standpoint where I think US companies are valued higher than Canadian companies, but I think you have the ability to grow and penetrate this market and then maybe take some of the US market as well.
So for a common investor, how do they find these other companies getting valued in the market? Like, is there any any platform where they can go and learn about similar companies' valuation?
I don't know that you have a platform where you can learn about similar companies' valuation. There's a subscription you can sign up for called PitchBook. I'm not subscribed to it, but I think they give you the valuations of many companies. But that doesn't mean that you know the type of traction the company has. It doesn't mean that you know how far you can maybe get insight as to how many employees they have and how much money they've raised and what valuation. But you really have to spend time doing due diligence on various startups to know, hey, startups with 1,000 customers in this space have actually traded at a 50 million valuation. And turns out this company with 500 is only trading at a 5 million valuation, but I think they'll grow to this stage. So
Who's new to this whole startup world, how will you guide him to start from where?
I think one of the hardest things is to get deal flow and is to find people that want to get your capital. So letting people know that you're looking to invest in startups is one thing. And then looking at the information. I think, you pass on your first few. And by pass, I mean, you get the information. That doesn't mean you invest right away. But I think you have to really build a database of what information is out there and what is better than not. So I always say the enemy of good is not bad. The enemy of good is great. So unless you know what's great, you're not going to be able to pick winners.
Is it something you do full time today, like investment in startups?
No, but it also doesn't take me a lot of time to evaluate a startup because there's not much to evaluate. You either believe in the company and the founders and the vision that they have, or you don't.
Got it. Now, sticking to a little bit more on the valuation side, whether it is AI or other sector, there can be like two way to look at it. One is a pre-revenue stage valuation, one is a post-revenue stage. Do you only look at post-revenue or you also look at pre-revenue?
I also look at pre-revenue, but they have to have a really, really strong team and they have to have traction that has to become in at least, you have at least 100 people signed up on your email list, or it has to be something along those lines where they can show traction without revenue. If it's just, here's our ideas, it's most likely a pass for me. I'm going to say, you know what, I'll help you with this and let's validate this and see if there's a market for it and to see if there's demand for it. Such as, we've done 100 customer interviews and they've said that this is something that they're interested in. That's also fine. But if it's just an idea that somebody came up with yesterday and they haven't really spent much time on trying to develop the market, they haven't come up with a minimum viable product, they haven't really tested the market, then it's usually going to be a pass.
So to summarize, like if you want to invest in pre-revenue, there has to be at least some operating data, some traction. Just an idea is not enough. It's a pass for you. Now, if I look at your portfolio, right, what percentage is post-revenue and pre-revenue?
It's probably 80% post revenue, but post revenue can mean $1,000 in sales sometimes. It's not like I'm expecting it to be $100,000 in sale. It's really minor. It's really, we started here and our customers are paying. A lot of models start as freemium models, and freemium can be pre-revenue as well, right? We have 1,000 free users. Well, that's great, in my opinion.
And does it really matter whether the company is Series A funding stage or Series B? Like, do you look at those stages too?
It doesn't matter to me. I have invested in some cases into later series funding stages, but I usually try to stick to earlier stage companies because the high growth companies that are in the later series, I think there's a high chance of them going down in value. A lot of times it's based on hype. That doesn't mean that they can't grow, but I would rather go on something where I think this company can go 10 times higher.
So out of this 20 investment, Alex, my understanding is that you lost money in one or two. So your success rate is pretty high. Can you share a bit more? Like, how did you made it?
One of them has gone to zero, and all the other ones have increased in value. The one that went to zero, the founder was kicked out of his own company, and about a year and a half later, that company went to zero, which is going back to why I think you invest in founders because they have the vision, they have the drive, they have the motivation. There's something more to it for them. And all the other ones, they've gone up in value. They've raised money at subsequent rounds, many times, multiple valuations higher. And we have multiple raises at higher valuations. So far, so good.
Do you do any kind of cash flow analysis or some kind of EBITDA multiple or some kind of like, do you do any of those technique or it is pretty much comparing their valuation with other industries?
Comparing their valuation mostly with what I think is reasonable based on where I think they can go. So a lot of investments are done based on SAFE, simple agreement for future equity, and then you maybe get some discount to future valuation. And when I'm doing evaluation, it's not what we think the company is worth today, right? You're getting essentially subscription into the company based on some future value, but you're able to participate in it today. So that's how I think about it. It's not about what's the value today. It's about what the value can be and is it realistic for me to get that portion of the revenue once they can achieve those goals.
And when we talk about investing in instrument, it is always equity, or there are other forms of like
There's
instrumental
other forms
investment.
as well. There's convertible debentures, which is actually my favorite, but a lot of companies don't like it because this way, if there's any sort of residual value, then it goes to the debenture holders first and before the equity holders. But convertible debentures are my favorite because you have higher security than equity, but you still convert later on into equity.
Can you share a little bit more for my viewers what is convertible debenture is?
So let's just say if I do a $50,000 investment in convertible debenture at a $10 million valuation with a 20% discount, that's let's just say a standard term, could be $7 million valuation. And let's just do it for simple math. That means if the company was to sell for $8 million or liquidate for $8 million or even $3 million, as a debenture holder, I would get priority. So I'd get my 50,000 back first, even if they never make it to 10 million valuation. But let's just say they make it to $100 million valuation. Well, I can convert my debt of $50,000 at a $10 million valuation, but a 20% discount. So I can actually convert it at an $8 million valuation. So if they end up raising money at a $10 million valuation next time, I get to convert at 8 million. So that's why I like convertible debentures.
So there is a some sort of security plus there is a opportunity for upsides.
Correct.
Like what is the range of your investment size?
So I right now try to stick to like below 50,000 is my threshold in this early stage range. And I'll maybe go as low as like a 5,000 if it's purely speculative on that side of things. But I rarely do like a $5,000 investment. It's more of a, I want to follow the company and I want to see what they're doing, and I might come in at a later round. And at the later round, I might invest, another 25 or 50,000 at a later round.
And when you invest in the like what do you get like in form of it's a digital equity certificate? That's what you get.
Yeah, usually you have a subscription form that you usually get. Sometimes they send you a copy or a share certificate. A lot of companies a platform called Carta where you just get a digital share certificate. But if you have a convertible debenture, you really just have that convertible debenture note until you convert over to equity.
And then when it comes to exit, is it always like in the next round of funding you can exit, or there is a option to exit before the next round of funding?
Sometimes you can't exit in the next round of funding, but let's just say if they've done 2 or 3 rounds and they're getting a bigger investor in, the bigger investor might want to clean up the cap table and he might offer to previous shareholders, hey, you know what, we're investing at a $100 million valuation. If anyone wants to, sell us part of their equity previously, we'll buy it from you at like, let's say a $70 million valuation. So you can sell it to you can sell a portion, whether all or some of it, to one of the new shareholders coming in. Like let's say if it's a Series C or Series D investor, they'll sometimes pick up some of the shares for cheaper from existing investors. Or alternatively, you have to wait for like an IPO or a dividend if the company makes it to that stage.
But it's fair to say that if you're investing in startup, it's not as liquid as equity. You have to wait for the next round of funding, and once in a while, investor can buy before the next round of funding, right? It's a little less liquid. It's a fair to say that, right?
It's very illiquid. I would say if you need the money in the next 10 years, I wouldn't invest it into a startup.
This journey of investment, do you get any monthly or quarterly reports on the performance of the company?
Usually you want to get quarterly. Semi-annual is more common. And then annual is kind of like the minimum.
And what's there? Just financials, or there are traction reports also?
It depends on the company and the management team. Some companies are really great. They give you updates on a quarterly basis based on traction. They'll tell you what they need help with. They'll tell you things that have gone great. They'll tell you, who they've hired. They'll tell you new markets they've penetrated. They tell you what's changed in their industry, how their industry is getting harder. Some of them ask for help. They look for referrals for clients. So it really depends. Some will just share, we were in the news and we were hosted at this podcast or we were at this event. So it really depends.
So have you come across where you wanted more information about the company and they're not been sharing a lot? You were able to write them back that look, I need a little bit of more information. Is that possible, or you think that's typically?
I think it'd be nice to have more information, but at the same time, there's not really much you can do anyways with the information because you're kind of stuck. It's not like you can sell it. So it's not really something that crosses my mind because even if I have more information, what can I do with it?
If I have to summarize investment in startup, few points from your experience, I think number one is knowing the founder very well. Number two is industry. Okay. Number three is traction. right? Understanding the operating KPIs, the operating performance indicators. Number four is the valuation of the future. Like today, there is a valuation, but how much that valuation can go up in the future. And you do that analysis based on your personal knowledge and your study about that industry, that company compared to other companies, right? So those are the four important parameters, right? Like, is that a fair way to look at it?
I think that's a very fair way to look at it. And to even simplify it more is, do I think it's realistic for this company to go from a 5 million valuation to a 100 million valuation? What has to go right?
Now, shifting gears a bit over here. So what are you up today? I mean, I see that you are into music industry. Can you share a little bit more about it?
Yeah, the music industry takes up a majority of my time, and I'd say probably 90% of my time. And that's been really exciting. We've been growing a fund that's now north of $100 million that we started just over 4 years ago.
So what is your exact role over here?
So the role is to essentially source deals, find deals, just like I was doing with angel investments, and then evaluating those opportunities, analyzing them, seeing what's the historical revenue, the traction essentially, as it relates to, how have these songs performed, how has the artist performed, what's the demographic of their listeners, is their listener base growing, how many events do they have going on, and analyzing all of that data and seeing, what's the future cash flows of these songs that we're looking to buy the ownership rights to. And then we make an offer based on our future cash flow. We try to achieve certain returns, and then if they accept it, we close on the deal, and then we start owning the revenue, and then we start collecting on that revenue. So
You look at your journey. I mean, if I see that starting from, soda, selling soda in the school to legal tech and then real estate and then, social media, healthcare, AI and now music industry. So what next for you?
I'm really entrenched in the music industry, and one of the reasons I went into music was actually because of the Wharton program that we went to, and I started thinking about, what asset class is going to be around for as long as as long as I live. And so I wanted to get into an industry that's going to be around forever, and music's going to be around forever. In my opinion, it's been around since people could talk. It's integrated in every part of our lives, and there's so much growth in the area, from streaming platforms to people inserting to their Snapchat and TikTok and Facebook videos. And every time music is used, the rights holders get paid, and the industry is just getting more and more sophisticated with collecting all that revenue. So I think there's just a lot of opportunity there.
It's interesting to know. I knew that healthcare will be there forever, technology will be there forever. Now I am learning that music will be there forever. You can invest in stocks and crypto, but that entrepreneur feeling you get investing in startups, as you said, that look, can I do it myself, right? So that means you are thinking like an entrepreneur. That high of being an entrepreneur, you get that through investing in startups. And of course, there is a risk, right? But again, there is high return also, and maybe one of the lucky one have made so much successful investment. No, thank you so much, Alex, for your time. I really enjoyed our conversation. I really learned a lot. See, again, this topic is so vast. We need a lot more episode to really cover lot more into deeper. But definitely, there are some really good pointers from this conversation. Thank you so much. Thank you, guys. I'll see you in the next podcast.